Just a few stocks before we go ahead to our guests. Sri Infra, like I highlighted before, now is down 14.5%. Though we have seen a slight bit of a recovery coming back into Bank Nifty. The index is now down about 0.8%, so under 1% from being down almost 1.2, 1.3% in early trade. So some pickup there. For the Nifty, we've reached 11,000, trading around 11,000 yet again. So the last 3 or 4 trading sessions, it's been bouncing in and out of this range. There's not been a convincing breakdown from these levels, which is heartening to see. And the fact that those put writers at these levels are holding strong ground. Let's bring in our expert then, Shailendra Kumar, Director and CIO at Narnolia Securities, joins us on the show right now. Shailendra, thanks very much for taking out the time. Just want to know what kind of a setup are you viewing for the markets right now in terms of being very stock specific, taking index calls? What should one look at before taking a trade?
Yeah. So Nifty is down by about 700 points from the peak a month back, right? Now that means Nifty has fallen only by 6%. But the kind of atmosphere which is there in the minds of market participants, as if it's a full-blown bear market, right? Primarily, sentiments are emanating because the small and the mid-cap segment of the market is in a kind of a declining mode since the beginning of the year. If you look at the Nifty per se, the fall is 6%, number one. If I go back 5 years, 2013 to 18, last 5-year rally, Nifty has behaved in a very disciplined manner, I would say, in terms of valuation. So every time it goes to 18 time 1 year forward, it bounces back and it goes to 24 time, right? Now, if that kind of envelope is going to remain there for Nifty in going forward, then surely anything below 11,000 would be a very appropriate level to start accumulating stocks again. So last time when we spoke, I was a little concerned about the risk reward becoming disfavorable, but at below 11,000, surely the odd becomes favorable to the buyers. Having said that, the question is like whether the valuation envelope which was there for last 5 years will remain will be going for the next 2-3 years or not. Now, every time bouncing from 18 time P primarily rested on 4 theses, right? First was the bond rate was declining. So 2013, if you remember November, the 10-year Indian bond was 9.3% or thereabout. And it kept on falling, and we were a year back in July of 2017, we were like 6.4 or 6.3%. So that bond yield getting down continuously for 4 years helped the PE becoming remaining higher. Also the domestic macro, because of crude and other factors, were very robust. Thirdly, the policy regime was very stable, and there was a hope for earning revival. The 4 factors which made the PE remain higher than 18 time 1 year forward. Now, if I look at today currently, surely 2 of the jing has gone out. So no longer the interest rate favors you. So the bond yield last year was 6.4%. Now it is like 8% plus, right?
Right.
So the bull market, the bear, so there is already a bear market happening in the bond market. And secondly, because of election overhang, you don't have so much of a policy certainty than what you had, say, a year back or 2 years back, right?
True.
So, yeah.
No, so
yeah,
the question is this, Shailendra. So I take on board some of the points that you're making. Where I differ marginally is that yes, the correction has largely been in the mid-cap and the small-cap end of the market, but some of the larger mid-caps have corrected quite significantly. Now, we've seen that happening in the NBFC space predominantly, but it's spread to other names as well. Some of the large quality paper on the NBFC side has corrected anywhere between 30% to 50%. And these are not names that are necessarily having an ALM mismatch or a credit risk in their portfolio, but they've all been taken down. That shows the sentiment of the market. You believe people will put in money to work at these levels while the sentiment is the way it is?
Yeah, right. So, see, pessimism is always good for a buyer, right? So, you can't get in a roaring bull market, you don't get a SDFC bank at a 2.5 time 1 year forward earnings. So, that's for sure. So, having said that, look at the NBFC, which you mentioned it right now. There are 3 ways to look at it right now. One, from the angle of interest rate cycle. the other from the angle of credit cycle, the third from the valuation angle per se. Now, as I said, the interest rate cycle for sure is worsening. The bond market is in a bear. So last 1 year we have from 6.4 we have gone to 8.1, and because the US 10-year is already 3% plus, and the way US Fed has anchored the participant, people are more comfortable with something like going to 4% 10-year in US in say 6-9 months than anything less than that. Now, in a scenario where it will be 4% plus 10-year in US, you can't think of a scenario where Indian 10-year will be less than 8%. So 8% is here, and it will remain here for quite some time. So that's the one part of it. Like, naturally on the NBFC side, particularly where the asset liability is not at least for the shorter term, because say housing finance company particularly, which has gone the 50% 30% kind of a brunt, look at their balance sheet. They finance asset primarily for 15-20 years. Whenever they lend for a housing mortgage, the loans are for 10 years, 15 years, 20 years. But those assets are getting financed through 1 year, 3 year, 5 year papers, right? So there is inherently asset liability mismatch. Now, in a worsening interest rate scenario, there surely will be happening a circumstances where the credit spread will start behaving differently for these names, right? Secondly, the kind of inflow which is coming to the bond market, right? So FII, if you look at the foreigners, 2018 will be the year where the net sale by the foreigners will be highest among any calendar year since the time they started investing into Indian debt papers, right? So in terms of buyers in the bond market has almost squeezed away in terms of foreigners. Locally also, if you look at the mutual fund numbers, there are hardly any inflow towards the fixed income side of the markets.
Yeah, Shailendra, due to paucity of time, I really can't get into such a detailed discussion. But to sum it up, would you reckon that there is more pain for some of these NBFCs, or do you think that some of them provide attractive opportunities?
Yes, so see, what I would suggest to investor is basically, the larger name like HDFC, they have got to a valuation where they were, only bearing to, if you remove the 2009 calendar year, HDFC Limited, I'm saying the HDFC Limited never traded at a valuation of 1 year forward or a 2 year forward 2.5 time price to book, right? It's a franchise. Every businesses that they have started in their life journey, whether bank or a insurance or a AMC, they all have done wonderful, right? So you can't doubt the management pedigree. You can't, they have handled so many ups and downs in the business cycle. So you can't doubt today that this kind of a different interest rate and credit cycle environment will suddenly make HDFC management not competent enough to manage the volatile times ahead. So there are names. Surely go for the larger names because you have a management confidence going forward, right? Don't go for some names where the risk reward ratio, so don't go for the names where the higher risk, higher return, exists. So go for the larger name, but I'll surely try to, go and buy in this pessimistic market for sure.
Yeah. Shailendra, just one last question, on a stock which is now sub 200, I mean, around that mark, we'd seen a Yes Bank, being beaten out of shape, the overhang of the succession of Mr. Rana Kapoor. Does one completely wash their hands off this stock if they have it in their portfolio?
Yeah, so like, see, there are two sides of it. Like, for sure, we are like bearing Rana, Kapoor, like, for last three, since the time Yes Bank started, you had only one name, leading the bank from the front. The kind of the management depth you have seen in other names like HDFC and other. You don't have that kind of a name confidence for Yes Bank. At least I don't have in that order. So surely I would like to see how the event unfold, what the RBI does for the request they have made for extension of the current CMD for some more months. So I would not be dabbling just now on the price. Surely it's a good watch because the liability franchise that they have built is very attractive for somebody to at least look at the stock.
All right. We'll leave it at that, Shailendra. It was a pleasure chatting with you and getting your views on the show. So HDFC Limited is one stock that Shailendra sees value in at this current point in time. The stock's down about 2%, 1731. Yes Bank on the other side.